All right, good afternoon, good evening, good morning, wherever you are in the world. Thank you so much for joining. It's Sunday, 1 p.m. here, April 5th, 2020. And my name is Amal. For those of you who are not familiar with me, I am the owner and the head analyst of the Cryptosomniac community, where we do cryptocurrency analysis. Faisal is our equities analyst over here. He does equities analysis. He also takes care of the oil side of the commodities channel. Faisal and I both pitch into the options side as well, and we have our Forex chat as well. So our community predominantly trades crypto, but we have also a leaning on equities. We're starting to open up our community more so towards Forex, equities, as well as oil to be traded or invested as assets. Now, first thing we want to tell you guys, obviously, is today's stock market and economy review is not to be considered as investment or financial advice. Faisal and I are merely giving you our opinion on the markets, telling you what we are doing in the markets, and please do consult your financial advisor or investment strategist regarding any investments you may have, okay? So what we're gonna start off today, folks, is I'm gonna introduce Faisal in a second, and what we're gonna do is explain to you the journey that we're going to take today on this video call, this podcast, whatever you want to call it, okay? So Faisal, first things first, welcome.
Good to be here, man. Hope you're doing good.
Doing great, man, doing great. I'm really excited to host today's session with you because we have about 40 plus people in the channel right now just watching, and I think,
Oh,
yeah, I know, it's big numbers, man.
I know, that's
And
cool.
and again, folks, for those of you who are not familiar with our community, we have, as you can see, over 200 people in our community. People come on and off. Some are active traders, like Faisal and I are. Some are longer term, long term horizon investors. Whether they're crypto investors, whether they want to get into oil or equities or forex, whatever floats their boat. These are the assets that we trade. Okay, and you can check out all this information on our website, cryptosomniac.com. You can hit the products page right there, and you could join our Advantage membership for $97 a month. And this is the community that you get to hang out with. We have different chat channels. You can discuss anything, whether it's regarding currencies. If you have questions regarding equities for Faisal or myself, oil chat, options, etc., or even crypto. Okay, so today, what we're going to do is we are going to do a US economy and stock market review. Now, again, we're not biased towards just America. It's just because of the fact that Faisal and I are from here. We understand this market better than any other market. And for the most part, the American economy and the stock market has a good amount of influence and pull on global markets. So if you get a good idea and an understanding of what's happening in America, you might get a broader landscape understanding of what's happening around the world too. Okay, especially given the fact that we're dealing with the same exogenous events, which is the COVID virus. Everyone is dealing with it almost in the same way. It's wreaking the same havoc in every person's economy, respectively. So what we're going to do is we're going to tackle this thing together. And so we're going to start off with explaining to you in American stock market economy where we are, where we go from here. And then after that, at the end, we're going to talk about the takeaways that you can look forward to in terms of investments or stocks that Faisal and I are looking at for actively trading or passively investing. Okay. So with that being said, let's get started. All right. So where we are. Okay. Let's go through the COVID numbers, right? So here's the most updated list, and obviously we have to start off with a grim picture of understanding where we are in the world in terms of infections and deaths, etc. Okay, so global infection rates cases are about 1.25 million now, about close to 70,000 deaths. We have a good, 255,000 recovered, right? And then these unresolved are obviously, they're not able to figure out if the patient is still serious or critical. Is he going to recover? They're still in the midst of that process, okay? America being the one who is obviously number one in this, 325,000 cases, about 9,200 deaths, and more new deaths just piling up, Okay. Now, the reason we want to take an understanding of this picture of the raw data behind what's happening in the COVID event is because that is the most critical point of understanding how the market itself and the economy is reacting to the virus or how it has already reacted. All right. So I'll let Faisal chime in a little bit on his take of how the numbers look and how the market has reacted so far versus how we can anticipate its reaction going forward. And
Yeah.
real quick, for those of you who are unfamiliar with our charts and how we're looking at data, we're going to do our best to explain to you exactly how to read these charts, what kind of data we're looking at. But we're expecting just a bit of prerequisite knowledge when it comes to understanding just a bit about how markets operate and function. So don't get bogged down if you do not understand some terminology or if you're not understanding what we're explaining in a chart. Just try to watch the entire video and then we'll put out the notes later. And if you have questions for us, we will answer them at the end. Okay. So now that I've prefaced that, I will let Faisal get started. So Faisal, where are we?
Well, first of all, that was a great explanation. Yeah, for those of you who are not familiar with charts, I gotta say it's okay because right now the charts really don't mean that much. If everything's going in a straight down line to the downside, then there's only so much a 50-day moving average is going to do for you. Just to touch on the numbers, I think they become really important as things go, progressively, as time progressively goes forward. But for the most part, you shouldn't really get too caught up in the daily cases because it's already known. Okay, at this point, we've already had a 30% drop. Now is not the time to say, okay, as each day goes by and we are obviously going to get more and more cases, don't expect the market to consistently sell off on that news. The question becomes how much bad news is exactly priced into the market. So when we had that 30%.
Oh, Faisal, I think you cut out, but let me unmute you.
Hello?
Yeah, we can hear you now. Sorry about that.
Okay. Yeah, so when we sold off recently, we took a 30% drop, which ended up erasing 4 years of respected gains in the stock market. That's real value lost, but that's not necessarily, lost in terms of once this virus clears up, it's not like a usual recovery, that we saw in the '08 type of recovery. We won't need as much change or infrastructure replacement to deal with the situations. It's kind of like we're hoping everything goes back to normal. If you reference China, things are starting to go back to normal a little bit and life is coming back to normalcy. We hope the same can do it for there. And so, like I said, at what point do we figure out how much bad is priced into the market? It's not necessarily directly related to the numbers at this point. I think if one day you saw numbers jump like 100,000 in a day, God forbid, yeah, I think then the market would not be expecting that. But the market is expecting a gradual increase as we've seen with the lack of momentum to the upside. But I'm sure in some point in the near future, this is my own theory, we'll probably see another leg down. But at some point you will have to, the market will have to start pricing in the recovery cycle and how things are going to get better. And I think people have to start switching their investment phase from totally negative to then somewhat optimistic, because it's usually during those really grim times that end up being the best times to buy. So, don't get too caught up in the numbers is basically what I'm saying, but they do matter ultimately.
Good point. Good point. Yeah, I would say I'm definitely on the same page as you. I think for now, the market has clearly factored in possibly the amounts of deaths that we may be anticipating. Clearly, the market has obviously factored in the 10 million jobless numbers that came out, because the 2 weeks ago when 3.3 million jobless numbers came out, we had this move up in the day, okay? And then the following week when the 6.2 million or 6.5 million jobless claims came out, we saw another pop. So when the market is actually moving, in the opposite direction of bad news, it's essentially saying that, hey, it looks like at least for now, the temporary bottom was formed. Things got aggressively sold. Let's get some mean reversion in, meaning that let's bring the market back to an equilibrium where we start understanding, okay, how much worse could the picture get? What other factors in terms of the economy, in terms of numbers, are we expecting or have we not factored in? And kind of like Faisal, I also expect another leg down. One of the more famous investors, Dow Theory, he states that usually there's 3 different cycles, whether it's in bull or bear markets. In bear markets, you usually have the first phase, which is a pretty sharp, steep drop. The second phase is usually, you're chopping around your consolidation. And then the next leg down is usually your big capitulation that you see. So, there's a statistic that I pulled up. Let me see here exactly where it is. So I pulled this up from, I forgot who, maybe Chamath. He said that if you go back and look at the history, there are 9 times that the market has sold off about 30% or so since the 1920s. So it's pretty normal, right? But you get one of these every 10 years or so, and you look at every one of them, you look at these as bear market rallies. And what he's effectively saying is that this is your dead cat bounce right here, and this is your bear market rally, okay? And this next leg to that is where people really need to be prepared. This is where most people get trapped in this particular area because you're trying to catch the knife and you're trying to think that this is the bottom of the market and this phase right here, you're going to buy, okay? And then when the next leg down comes down, you're probably going to get torched and you're going to sell at a loss. So our goal today is to sort of look at the broader data and look at the charts themselves and help you understand where we could potentially be and what you could anticipate going forward for the next several weeks or several months, okay? So yeah, I mean, I'm there with you, Faisal. I think there's a couple of important points that I do want to point out, okay? So before we get to, if we bottomed or not, right? We talked about this last week. One of the big indicators that Warren Buffett uses is the TMC to GNP indicator, which is a total market cap weighed against the gross national product, okay? In this particular instance, we can see effectively that even pre-coronavirus, okay, so if we look at this indicator, pre-coronavirus, we were all the way up towards 150% of total market cap to GDP. So the market itself was already well ahead of what the valuations were as per GDP or GNP. So they're already forecasting in the future, like we're expecting growth. And so in that particular instance, we were already overvalued. Now, where we are right now is modestly overvalued, but overvalued nonetheless. So when you look at this, Faisal, when you look at a market like this, are you thinking the same thing as this particular indicator? Or are you on the same train of thought that, hey, I still do think that there's maybe some overvalued, overhyped equities? Or do you think that, hey, this might be the time to start looking for big long-term buys?
Well, I'm the type of investor. I've been doing this for a little bit, not as long as an old person, but I've been trading for around maybe like 7-8 years, and I know what I know and I know what I don't. So I really don't know exactly how the market's going to react. I'm just going to wait for it to tell me what it wants to do. I don't look at the GDP numbers and try and calculate, the relativity to the stock market pricing or anything like that. I just, data can look bad till it doesn't. And I think sometimes it just can switch on a dime, and we're dealing with a situation with this virus where I think data can switch at the time. So even though those metrics like that look bad for now, it still could be, you could make the argument that it's already priced into the market. But for right now, I think how I'm thinking about everything is I'm not really looking so much as economic data, but more so on the time frame of this virus cycle. So I've mentioned before that we're about to go into, I think Trump also said it too, these next couple of weeks are going to be terrible. And I think it's during this time that the market will start to, or will kind of, price in a little bit more bad news. We're probably going to need more stimulus. And that changes those GDP numbers as well. For the most part, it's just about waiting and seeing. I'm not looking to buy any long-term names unless they're just drastically oversold, like Uber going down to $13 and like United Airlines going down to like 18 when I know they're going to get bailed out. Like out of all the sectors, the airlines are going to be the first ones to get bailed out. So I'm waiting for opportunities like that, but I'm not willing to take a shot on many things at this stage, as far as, short-term trades or even medium-term swing trades.
Great point. Great point. And I'm glad you said that because one of the things that we actually do pretty well in this community, especially yourself, we provide a really great insight and analysis in different markets. And because you and I are actively trading these markets, at least, I'm in the same boat as you. I'm really not looking for any long-term buys anytime soon. I'm trading this market in and out. So, I explain to my our advantage members every single day, the kinds of positions that we're taking. And for the most part, in the stock market and equities, I'm mostly positioned short. I shorted QQQ. I took some puts on the SPY for April, which is some short dated calls, and then long dated, I have July, September, and I'm thinking about opening one up for January. So for the most part, I'm kind of in the same boat as you. Like, clearly show that we've bottomed. But to go one step further, I think one thing that really scares me was before coming into COVID and coronavirus, tanking the market, right? Corporate debt, all-time highs. Consumer debt, all-time highs. State and municipal debt, all-time highs, okay? Consumers and corporations really had no savings, right? For example, Boeing itself, okay? A lot of people don't know, but Boeing was already, starting to do its whole distribution cycle and starting to sell off before the coronavirus hit. You already saw that they had significant issues, whether it was management or, internally in their company. So when I hear companies like Boeing getting bailouts and airlines, it's not that I don't like the fact that they're getting bailouts. It's that it makes me really question the fragility of the U.S. economy when you have such a credit and debt-based society. And I mean, even the consumers, right? How can we call ourselves the strongest economy, and within 1 month, we implode completely? Okay, and we need massive fiscal stimulus across the board. We need bailouts. We need government intervention to step up and basically backstop all the sliding in the market that's happening. So that is one area that I'm really not comfortable with, that, I personally feel, okay, the US economy is going to get back on track, soon, like next quarter or next 2 quarters. I'm more of the opinion that this is a multi-quarter, maybe 12 to 18 month cycle.
Oh man, I gotta disagree with you on that one. I like your points that yes, we were at all-time consumer debt, we were at all-time corporate debt, but on the flip side, the only reason we were able to get to those points was because earnings were high. The consumer was extremely strong. Everything was supposedly going very well, to the point where, you could get a loan if you really had a good idea. And, for the most part, that really did fuel a lot of this, exactly what you said, this society that is built on growing fast. And to grow fast, you have to acquire debt. And, things like this aren't supposed to happen. I think we're seeing a lot in Europe as far as what they're trying to do to help save the economy. It just feels like this problem won't be stuck with us because everyone is dealing with it. Like, everyone is pumping money into their systems because everyone is kind of on the same credit system. I mean, sure, you could say that we are a lot more leveraged. We have a lot more companies, and we expand so much faster than any other country as in terms of corporate earnings and corporate growth internationally. But
Right.
I think because of that, relatively, if we were just dealing with this virus issue ourselves, sure, I think you could say there could be a multi-quarter free fall and a rearrangement of power in the whole global economy. But the fact of the matter is, because everyone is dealing with the same issue, it kind of mitigates how long I think it'll impact the global economy in the long term, and especially the U.S. economy.
Yeah, that's actually a great point. That you are right that the world at large is dealing with this, and I think the EMs, the emerging markets, are probably going to suffer a lot more and a lot harder than the U.S. economy will. And I don't say that lightly, because America is already starting to see a rise in unemployment. There are some statistics about spike in domestic abuse, spike in gun purchases, and obviously this fact to me, I mean, this is where America will, be as always the funny joke where it comes to, whenever there's a crisis like looming, we, right away go to buying guns. I
Bro,
mean, it's
oh
not
yeah,
like you can, it's not like you could shoot the fucking coronavirus. Like, what are you buying guns for, But I feel like, we have, in America, there's obviously that cynical view of like, the government's going to, take our rights away and this and that. And I think I very much respect that American spirit, but I think the long-term psychological impact I think that this will have on the country, for the foreseeable future, I think is really underestimated. I really do believe that going forward, I think the world is really not going to be the same again, right? So like I explained that, where do we go from here, right? So what is really the new normal? I mean, I don't think we're ever going to go back to pre-COVID life. And I'm not saying that the US economy is never going to get back on track or anything like that. I'm just saying it's impossible to say that life itself is going to be different. International relations, I think they're going to be vastly different. Borders themselves, I think they're going to be a little bit more tighter, right? And the interesting thing about all this is if you kind of look across the world, the idea of deglobalizing and nationalizing was already in effect. And now people such as, say the Trump administration, Modi in India, people in Poland, or, these nationalistic governments that are coming up, they now have an excuse to essentially walk back and say, hey, we don't really want to be that welcoming towards immigrants. We do not want to have, bigger international relationships for importing and exporting. Maybe we can start building more supply chains internally. As Trump says, make America great again and bring the jobs back. Do you think that there's going to be sort of a repatriation of, bringing manufacturing jobs back, bringing the supply chains back into America? And do you think that that's going to sort of, be the norm, quote unquote, going forward?
Well, going forward, sure. You could say that is the norm. I think everyone kind of saw what happened with the whole 3M thing about how they manufactured the masks in China, and China was kind of imposing them to not send it back to the US. And it's fears like those that end up prompting moves of nationalization, exactly how you explained. But I don't know if I agree with the whole new normal thing. I think psychologically, people will get back to their lives, in this from a psychological standpoint, like 5 years. Economy will get back going in 1, maybe 2 years at most. But people's habits for sure have changed. I think definitely people will always keep hand sanitizer everywhere they go now, for sure.
Right.
But no, I think the main consumer habits will still be intact, and the market still can get back to levels where it was pre-corona, despite having some minor consumer changes.
Yeah, that's actually a good point. See, whenever I see drastic changes like this happening, whether it's just based on a particular region or if it's global, I always think to myself that how is this going to reshape economies and the world? And what can we look forward to in terms of, how the economical or technological changes? Because every cycle like this, every, downturn like this, like if we look at the 2008, 2009 cycle, okay, let's look at that, right? So that was more so tied with housing and finance, right? In this particular, where's 2008, 2009? Way back here, okay? So in this particular cycle, I mean, this was sort of like a isolated sector drawdown, right? You could say that it impacted, the financial services sector, and also the housing sector. But what we're seeing now is there is no sector that's safe, and there's no single asset class that's really safe, okay? So equities themselves across the board, whether it's housing, financial services, you talk about consumer goods, healthcare. Well, healthcare, ticked up a little bit, but pretty much everything saw a wide-scale drawdown. Okay.
Mm-hmm.
Now I think to myself, okay, what is going to be cleansed out of this process? All right. So what is going to be, what are the companies that are going to be weeded out of this market because they were not able to survive the pandemic because they didn't have enough cash flow to, even survive 30 days or 60 days or whatever. And is the government going to bail them out? Well, the government already has its hands full because it has to bail out airlines. It's already starting to think about oil. It's definitely doing cruise lines. It's already starting to backstop the slides in the corporate debt markets. It's already starting to pay people. So how much can the government really print and stop the slide of many markets and sectors across the board?
That's honestly a great question. I wish I knew the answer.
I swear.
Yeah, I wish I knew.
I think the point is that the one thing that I'm looking at, going forward, like if I were able to, look forward into the future, I would probably say that there's going to be possibly an exodus of businesses. And there's probably going to be an exodus of certain industries that already weren't cutting it, right? So for example, if you look back in the day, whether it was Blockbusters or things like Sears or, all these companies that sort of went bankrupt, this is the next coming of that. Whether you're talking about, I don't know, just as an example, like maybe Macy's or JCPenney, or you and I were talking about movie theaters, movie companies,
Mm-hmm. No, exactly. I think it could be a second coming of that, just exactly how you described. The only difference, I would think that this crisis is different than every other serious crisis we've had. And it really helps in this scenario is that the big banks were extremely healthy before this crisis happened. So there's also that support that's there where banks are extending credit lines to all the companies, even energy companies. I've talked to some people who work at JP Morgan, and they're like, we are perfectly comfortable with offering max credit lines if people need it, and we don't feel too stressed at the moment. Now, this was like a week, 2 weeks ago, but at that time, the market had been selling off, and the fear was kind of already in. So that's the only difference I would make. I don't know how much that is actually factored into the whole recovery process or anything, but I think that's something that could end up playing out as this thing transpires.
Yeah, and to go along with your point of central banks, see, I was actually of the opinion that I think central banks were already sort of struggling to add things to the balance sheet, right? So for example, if we start looking at, even the Federal Reserve, I mean, this is just like a straight vertical upshot. Just maybe a month ago, we were sitting at maybe a $4.1 trillion balance sheet. Now we're, on the upside of 5.8. I would not be surprised if next week we come in somewhere with $200 billion plus. So we're sitting at $6 billion. So
Mm-hmm.
we've effectively added about 30% to the Federal Reserve balance sheet in less than a month. Same thing if we start looking at central banks across the world, right? The ECB, Bank of Japan, the Bank of China, same thing, right? I mean, it's like the central banks are trying to backstop the sliding of economies, global economies of the world, with doing as much as they can in terms of printing money, but it's like trying to plug the Titanic, which is falling apart right in front of you, with a freaking cork. Like that's how I see it.
The Titanic with a freaking cork? I mean, I guess so. That's an interesting comparison.
But I think that the point is that I think the U.S. economy, especially the central banks, I don't think they were prepared. I mean, obviously, no one was really prepared for this kind of pressure. But in this particular case, I just find it really hard to believe that simply just printing money across the board, with the whole unlimited QE that the U.S. was talking about, is going to be the thing that saves people out of the current crisis that they're in. Because is $1,200 check really going to get people's lives back on track? I mean, I think 30 or 40% of the people, in America already live paycheck to paycheck, right? And they already have, let's just say, America already has a massive amount of debt in consumer debt. Our rent prices and income inequalities, the highest in the world. So if people are already struggling so much before COVID, and now you're telling people that, hey, you now have to live and depend on this $1,200 check, it's just hard for me to believe that like the government has really thought this through, that they can handle pretty much being, the credit card for everyone, all across the board in the U.S., whether it's corporations, corporate debt, bond yields, consumers, etc.
Yeah, that's an excellent way to put it. They kind of are the credit card for everyone right now. Um, I'm so curious to see how things play out because you're exactly right. $1,200 is not enough, especially on people on the East and West Coast. Down south here, $1,200 it makes you like it's pretty nice actually. Things are cheap down here, but East Coast, West Coast, you're gonna barely be able to pay rent.
Yeah,
So as those people can, and those sides are really heavily based on the service industry. They have, they're not as exposed. Well, actually, down here we have a lot of oil, and that's its own separate issue. But bottom line, yeah, the jobs that are probably going to be cut that cannot be done remotely are going to be lost for a fair amount of time, and those workers are going to be struggling beyond $1,200 worth. So it'll be interesting to
definitely.
see. I'm sure the government will have print more money and give that to people. That seems to be the solution. But the thing about that credit card is it's got an unlimited capacity. So that's pretty good.
Yeah,
There's no
that's a
credit
great
limit.
point. I wanted to circle back to the point about oil. Now, oil being about 8% GDP of America, it has about 9.7 million jobs that it supports as an industry. And obviously globally, I'm sure it's a big part of the overall global GDP as well. Oil obviously spilled, and I think you and I are of the opinion that oil has already started its decline, back from 2008, 2009. And I'm personally of the opinion that I don't think oil is ever going to see anywhere close to its previous highs in 2008. Now, when you look at something like oil and you start seeing companies like, what was it, Whittings, right here, petroleum, one of the more veteran companies, the shale markets, when you start seeing this company declare bankruptcy and you start seeing oil, right under $30. I mean, obviously the last few days it popped because Trump gave sort of the ultimatum that, hey, Saudi and, Russia, they're going to reduce their production, but it doesn't seem like they really want to stop. And given the fact that we've seen such a supply shock in the world, because of so much overproduction already with Russia and Saudi Arabia going in, and US being one of the larger producers as well, and essentially no demand, I'm really surprised to see that oil has even popped up, even the little that it did. What's your take on
That in my opinion, I think it continues to be part of a longer down cycle that I think has a little bit more volatility to the downside before it starts to make a new range. So if you want to zoom back a little bit, let's go ahead and look at the range that it made after the last sell-off. So it kind of traded between, around $35, and then at the top end was like $100. Let's just go ahead and say that.
it? Okay.
That was its previous defined range. Now we are going to enter in a period after breaking through that where the range could be somewhere between like $40 and like 18 or something like that. And you can see it, trade up and down through that. And I think that's how oil is going to play out for the remainder of its duration. It's always traded within ranges, but exactly like you said, I think we've seen the peak in oil pricing because we've already started to move closer towards alternative energy solutions. The technology is only going to get better as time goes on. And so, oil is swimming upstream here.
Yeah.
And I think, a bounce like we saw a couple of days ago was kind of off the hopes that OPEC would come to a deal. And that was partially one of the reasons why it sold off so much is because the whole Russia and Saudi Arabia thing. So it's natural for people to get optimistic again, but I'm still not a long-term believer in oil. I still don't even want to trade it because it's so unpredictable. But I'm definitely a wait and see. If it starts to break below, that previous low of 24 or 23 and a half, wherever it was, it's going to be
Right
scary.
around here. Yeah.
No, even below that. Yeah. I mean, that low set, that's kind of like, I mean, when the fear was the highest, we already know demand is so low.
Yeah.
OPEC canceled out on a deal. That is when the epitome of the fear hit because those events kind of hit at the same time. So that's the low I'm watching. If it breaks
That's a
that,
great point.
yeah, no. But if it breaks that, all hell breaks loose. And I think it's
Yeah.
just, you're going to see bankruptcies and job loss in the energy sector like never before.
Right. That's a great point. And sort of going on the side of oil, I don't know if you know, but the Canadian tar sands, they effectively traded to zero, like I think a week ago. I
No,
don't know if you
I didn't
saw
see
that chart.
that.
It
Mm-mm.
was crazy. Some of the oil futures were talking about, $8 or $12. And that to me was really like, okay, it looks like for people, in the um, oil industry and, the traders and investors are really preparing for Armageddon on oil because it has historically been, and you and I have spoken about this, it has historically been a an industry that has been pretty much debt ridden, and it's been really tough for them to make profits consistently, and they have so much debt that if they start to fail, companies like Wells Fargo and Citigroup that hold about, I think, a couple of hundred billion. I think Wells Fargo and Citigroup each own about 200 to 300 billion dollars of energy and oil debt. So you could then start seeing the ripple effect of oil, domino affecting into the financial service industry, and that rolls over. Then you might have, the banking sector sort of start to see its collapse. So I could see why America really needs to figure out this oil situation because this, if the oil industry starts seeing a decline, that means, shit's about to hit the fan.
Yeah, no, I love that you touched on the financial sector because I've been talking about that for the last week or so. You have a lot of exposure in relation to the billions of dollars that you see in the big banks like Citi, Morgan Stanley, whatever. But you look at a bank like Cadence, which is kind of like a mid-sized bank, and they are extremely levered in oil. Like this stock, this is one of the first banks to go. As you can see, it's dropped so damn much because they are so heavily exposed to oil. And so when these guys start to bankrupt, yeah, that'll cause a ripple in the lower guys and the upper guys, and it could end up shaking to be another financial crisis if oil does not get its shit together soon.
Yeah, yeah, that's a great point. Um, let's go back to now, the recovery, right? So obviously, I think you and I are still of the opinion that there might be, potentially another leg down. Would you say that there's a higher percentage of another leg down versus, us bottoming here? Is that how you're looking at it? If you were just, gun to your head.
I'm sorry, what did you just say?
I'm asking, do you think that there's another leg down of another decline in the equities markets, or are you thinking that there's a higher percentage of the market being bottomed where it did last week?
Hell no. Are you kidding me? I really think that's like a 70, or I'm sorry, yeah, 75-25% chance that we go down. Like I really
Yeah,
don't think like we are preparing so much right now. I love all the stimulus that's coming on right now. It really provides a nice floor, but we don't know the total effect. Like we're going to continuously, in my opinion, having to pump in more money as we, kind of get through this entire virus and see exactly the wasteland that it's laid out amongst small businesses and uh, relating to all industries.
yeah,
So I think for now it's too premature to say that we bottomed out. You can say that. I mean, I think it's possible that we could trade in a small range and kind of base out for the next 6 months. I think that's way more likely than us kind of rallying back to above 3,100 on the S&P for sure.
great point,
So,
great point.
so I think that's another aspect that people got to realize too, is that the market can trade within a range. It doesn't have to necessarily go back to its high after, the worst of the virus has passed.
Yeah, and I want to touch up upon that because I think there's still a lot of people out there who think that, we can just sort of like V-style recover out of this. And again, for those of you who are watching this video and you're not familiar of how, recoveries and equities or assets work, you can see right here, for example, previously during the trade war, we can define this potentially as a V-shaped recovery, right? So it's like a nice V shape. Sometimes you have a bit of a W shape, but you have, this kind of chop and then W out of this and then take off, okay? So there's different style of recoveries that, markets sort of create. I am of the opinion that I don't think there's going to be a V or a J or a L or a U, which are the more common themes in recoveries, right? Um, I'm kind of in your boat where I personally think that there's a higher chance of us sort of consolidating here for maybe a few weeks, a few months. But I think there's a certainly higher chance that we have another leg down, given the fact that the stimulus across the board is, in my opinion, the only thing that's allowing this market to trade where it's at. If it wasn't for the heavy stimulus and essentially the multi-trillion-dollar backstops that we're having in all asset classes, I would say we would have seen possibly 50% by mid-April for sure.
Damn, 50%. Wow.
Well, we already hit negative 35. We just had another 15% down is what I mean.
Gotcha. But that would be like a 50% drop in like, a month and a half span. That's crazy.
Yeah, I mean, I think it's crazy that we already dropped 35 or so percent in less than a month. That is, I think, the one thing that tells me that maybe we did drop too hard, too fast, and maybe we need to find a bit of equilibrium right here, and potentially test, where the sellers are and where the buyers are. And this is where, in terms of technicals and Wyckoff, Walter Wyckoff, he's a person who sort of did these schematics of how institutions do their distribution and accumulation of assets. He talks about, how typically there's going to be sort of like a range like this potentially, and this could be your distribution phase where institutions and banks are essentially letting go of their asset and they're trying to effectively get on cash. And in this particular phase is where most people fuck up. They think that this is the bottom. Hey, I got to catch the bottom right here because we're going to, recover out of this. And then eventually what happens is we start trading down, and then you start seeing, another drop like you did, like in 2008, 2009, where it was effectively like this. Let's go back to that chart. Where's 2008, 2009? So we spent about, a good 2-3 months in this little range right here. So we traded between, let's see, from this low to this high. We traded in a 15% range for 3 months. And then after that 3 months, we dropped from that high to this low, another 53%. So while people thought that this was a first, real sign of, okay, this could be the bottom, effectively you're buying into a trap, and, you might be essentially getting fleeced over the next few months. So that's what I want to tell people is, again, not that this is financial advice, but it might behoove you to sort of wait, sit back and see, and observe what the market is going to do. The best thing you can do right now is probably do your homework, okay, on what you want to pick up, possibly even think about, and again, not financial advice, but you could possibly think about, cutting down some of your asset for your long-term holds. Or if you want to double down, you can, if it's long-term stocks. So I want to get into that before we start taking questions, which is how are we, how are Faisal and I preparing for the market? And, what does this financial crisis going to do for, industries ahead? Okay. So first thing is, obviously, after every financial crisis, we already know that there's a sort of a cleansing of inefficient, fat model business companies. Okay. So I mean that, companies who effectively had really no savings, or they had, too many expenses, but not enough revenue, or they had maybe, I don't know, not enough growth for 2018, 2019. And now that they're looking at 2020 being a down year, this could be really their nail in the coffin that some of these industries might go away. And so some of these companies, that Faisal and I are looking at that potentially might go away is obviously the movie theater companies. You want to touch upon this, Faisal?
Yeah, sure. So first and foremost, let me just start off by saying this is not financial advice, but I wouldn't short them, right? Like these movie theater companies, even though I think they're probably going to go bankrupt. I think this process of them going bankrupt, yeah, you see, and the main point why I don't want to short them is they've already been priced in to go bankrupt, I think, in my opinion. And at this point, it's kind of like more of a trading scenario as far as, them bouncing up, them getting buyers optimistic. And for the most part, this stock's move is already done. But in a long-term picture, I think this bodes really well for studio companies like Universal, Disney, a lot of these companies are going to really benefit from this, because once these movie theater players end up going out of business, and I think they will, it becomes up to the studios to release new content, which is something they've never done before. So when a movie was released, you would have to go to a movie theater to see that new movie. Well, now companies like Comcast and Disney can just say, hey, we have a new streaming service that we just started up. We're going to be releasing new movies on that thing. And so I think overall, it's going to end up being a great long-term benefit for both these two players, especially because they have such large ecosystems of content, that their distribution will be unbelievably changed, because now they're able to add new content, not just their previous catalog. So I think for the long run, Disney and Comcast will both benefit once these movie players end up going out of business.
Yeah, that's a great point. And I'd probably throw in Netflix in that same boat. You know, Netflix being the company that will probably survive and thrive through this process.
Yeah, I would say, oh, I'm sorry,
Disney,
go ahead.
yeah, I would say Netflix, Amazon, and Disney, those are effectively going to start chipping away at, you know, the larger studio companies, and you know, start chipping away at the market cap of what movie theaters used to hold. So the point is, you know, going forward, you kind of have to look at the world in a different lens of, you know, we've seen this crazy event happen, right? And you have to think about the world around you, like, what is going to psychologically change in people's lives and behaviors? Well, number one, I mean, we'd already been seeing, you know, movie theater companies already seeing a decline in customers, you know, coming in and watching movies. Like, there's a crazy statistic that I think I posted up. I sent it to you, where you can see right here, the domestic box office brought in, you know, $5,200 between the days of March 20th and 26th this year. Which for that same time span last year, it was $204 million. If this is not telling of what's, you know, to come for movie theaters, I don't know what is. You know, this is like, it's effectively telling you, like, these guys are on their last, you know, dying breath. And so you have to start looking at the world of, how are things going to be reshaped? You know, what is going to come up versus go down? You know, so it's time now to start doing your homework. Sit back, you know, potentially just, if you have to be in cash heavy positions, that's what you got to do. You know, let the market do its thing. And then another thing that I want to talk about, Faisal, is what you and I do effectively is, because we're actively trading this market, you know, one thing that I've been doing personally is longing pretty much every weak currency that has a US debt exposure against the US dollar. So for example, dollar yen, dollar ZAR, and dollar CAD, as well as, you know, Australian dollar. And pretty much, you know, if you really want to trade like the Thai baht or, you know, Indian rupee, you can effectively trade those too, but these are my favorites to trade. And the reason I wanted to start explaining this to you guys as per a larger currency view is because, you know, let's do this. Okay, so let's start looking at it from a daily time frame. Okay, let's turn off this and let's start looking at things like Bitcoin compared to let's do S&P 500. Let's do US oil. Let's do US 10-year treasury notes. Let's do gold. Okay. And what else is there? I think that's pretty much it, right? So if we start looking at these assets, okay, number one, or actually I didn't put the DXY on there, which is the US dollar ticker. All right. So if you start looking at something like this, okay, one thing you need to understand coming into this conversation is that the US dollar is the world currency reserve. Okay. And countries across the world already effectively hold a lot of US dollars, and they, for the most part, you know, most of them hold some US treasury debt, right? So they hold bonds or they're holding US debt. So if you're looking at assets across the board and you're starting to see, you know, in the month of March, right, everything pretty much went down, whether it was Bitcoin, let's turn this on, whether it was Bitcoin, which is the black right there, whether it was the 10-year treasury notes, which was, you know, effectively going down previously before this move up. The gold ticker right there, gold was going down, US oil was going down. So investment managers and investors really had no safety in anything. except the US dollar, which was trading up, right? As you can see, as everything was getting sold, the US dollar was the only thing that was going up. And so you're probably wondering, well, why is that? Well, that's because most of these assets and debt across the world is denominated in US dollar. So if you're getting out of oil, if you're getting out of the US dollar, it's effectively getting out and you're looking for US dollar to get out of, okay? So countries across the board would rather pick the US dollar over their own currencies, right? And this is actually seen visibly when you start comparing, let's just say, dollar Colombian peso. I live in Colombia, so you could see that, the dollar effectively has been just taking charge against weaker emerging markets like Colombia, okay? So the dollar effectively started trading up, and, you can say that, okay, so the dollar, is the one thing that's getting strong against everything else. So what does that tell me? Well, there's a huge demand for dollars, okay? And assets themselves across the board pretty much saw larger sell-offs to US dollars. So the best thing that you can do if you're not shorting the market, like I guess, I do or Faisal does, you can effectively do the second best thing, which is potentially look forward to staying in safe havens such as the US dollar. Does that, can you sort of add to that, Faisal?
No, I mean, you pinned it exactly right. As people deleverage across the board, the dollar is going to gain strength, and I think that's a pretty good hedge in this environment to a lot of the downside, because as people sell, just like you said, they end up getting in cash.
Yeah, exactly. And this is another trade that I was in, the US dollar czar. Man, it has gotten crushed. Like you can see over the since end of March right here, it's up, 10%. The dollar is
Wow,
up 10% against ZAR.
that's huge.
So yeah, we have some, members who are watching this right now from South Africa, from Zambia. And I bet it's, going to start getting tough for them too, as you start seeing the dollar appreciate against their currencies and their own currency starting to see a devaluation across the board. Because if we're in an environment where the world itself is not really consuming goods and they're not effectively importing as much as they used to, countries like South Africa or even Colombia, Colombia is heavily dependent on oil. So if oil prices were already crushed and oil demand is already low, well, the Colombian economy is going to tank. And if the economy starts sliding down, the peso goes down with it. So you could effectively, the one strategy that I have is long everything against the dollar in EMs. So emerging markets like, South Africa, Colombia, possibly even the Indian rupee, Canadian dollar. That is what I'm doing. Now my question to you is, Faisal, I guess, what are you doing in this environment, and how are you, I guess, hedging your bets in this particular time?
So as of right now, I still am in my long-term positions, but for the most part, I like to protect myself from downside from a week-to-week basis by just playing weekly puts. Like if I think the market will have a volatile case, whether it's in the next couple of days, I choose to play puts that kind of expire within the end of the week. One, because it's obviously extremely cheap. Two, if I'm expecting volatility to be high, I can buy a lot out of the money price points and, it'd still be possible to make it by the end of the week. And three, if I want to play longer term, implied volatility is so high that the premiums you're paying are going to be really high if you're trying to go beyond, a week, 2 weeks. So I just try and stay away from there because the odds of making money is just so tough in my opinion. I've tried to do it in maybe another correction or so. I haven't had that much data to back it up with personally, but that's just from my own experience. But basically, if I see small opportunities, I'll just buy puts in like an ETF, just a couple puts just to protect my long-term assets. But for the most part, I'm not really actively looking to make big short positions or anything, because I think at this point, I'm still trying to figure out whether or not the market has priced in the worst. And if I feel like it has, then I'll just wait for the market to kind of bottom out. I'll wait for the market to maybe come at the lower end of the range before I play to the upside, or come near the top end of the range when I feel like I want to short. I was doing some research though over the weekend, and I think there are two names that I would like to short. One is Caterpillar, CAT. They're one of the largest industrial companies. They make a lot of the construction vehicles, whether it's like bulldozers or anything like that. They're huge. I really like this one as a short. As you can see, technically it never closed, or it's still under its breakdown gap. It still has a lot of exposure to the global economy. And if I believe the global economy will end up stalling out for a year, maybe 2 years, I don't think this stock will be trading at this valuation personally. And I think I'm looking to get into a short maybe this week, early this week. And then the next stock that I want to short is kind of a surprise because you would think it would perform well in this environment, but it's Peloton. And PETON.
PETON.
I think it's PTON.
Oh, PTON.
Yeah. So this stock just recently had an upgrade. I believe it was Friday. The stock has gone up quite a bit. I think people are starting to like it, that it's a stay-at-home exercise play. As people don't go to the gym, they still want to exercise. So they're like, I guess some people think you're going to buy a Peloton, but I still think Peloton's price point is just, it's way out there. I don't even like the product that much. So I'm looking to short this one. I think there's a lot of optimism that's truthfully not supposed to be there. And I think in a couple of months, probably next quarter or next 2 quarters, people will see that people really aren't buying Pelotons during this crisis. But, that's just my opinion. And technically, I think it's at a great point to short.
Yeah, that's actually a good point. There's certain companies across the board where I still do believe that there's, still very overvalued. And for those of you who are watching this right now, these are the things that we discuss in our community. And Faisal puts out these daily updates in the equities channel right here. And so, we effectively talk about different stocks, different positions that we're taking, intraday, intraweek, or even, options positions. Okay. So if you guys are interested in joining and, learning about this stuff, how to take advantage of this market, you can go to our website right here and hit the products page and you can join our membership. And if anything, you could come learn, you can come see exactly what we're seeing in the market, what we're trading. And like I said, this is the time to do homework. This is the time to learn a new skill set. Because you're effectively stuck at home, so you might as well fucking do something. Like that's a little bit more going to make you grow. So with that being said, I wanted to do 2 parts to the conclusion of this session. Okay, number one, things that I would personally stay away from in terms of stocks or equities or even other assets. Things that I'm doing right now, or me and Faisal are doing right now, whether it's for the shorter actively trading positions or versus the longer terms that we're looking at, for the 2, 4, 5 year horizons. Okay. So first thing, we already talked about movie theaters, right? REITs themselves, which are tied to real estate. I'm potentially, just going to start looking for shorts in these companies, but what's your take on REITs right now, Faisal?
Well, I was doing some homework yesterday, just kind of broadening my sense of what REITs are doing good, what REITs are doing bad. I was kind of under the assumption that almost all REITs were going to do bad. But there are a couple of them that are doing fine. I guess they must be leveraged pretty well or have a different portfolio of assets. But you look at companies like Store, STOR, and they have a lot of commercial real estate in their portfolio. They dropped 26% this week. In 1 week.
Wow.
And this stock is not a volatile stock. It has a 9.6% dividend yield. I mean, it's supposed to be a safe play. And to see this type of drop in 1 week, I mean, it's so telling because they have a very large portfolio of commercial businesses. And for me to see that is really concerning. And I think it tells a lot about the severity of the crisis that we're going through.
I would say that's a great point. Sorry to interject, but
no, you're fine.
If you're looking at REITs, I mean, there's 2 segments to consider, right? Obviously commercial and, then the private and personal properties, right? So if you're looking at real estate across the board and you're seeing people effectively not working, meaning that they may not be able to pay rent on time, and that, again, it's commercial or, personal. So what is effectively going to happen to some of these companies? Well, they're going to get torched, right? They might even start needing bailouts soon because they may not be able to pay their bills towards the banks, all right? So is that kind of your thought process on that?
I think when I was going over my research, a lot of them do have cash, so they will be able to weather out some storm. But for the most part, it's all about their assets in their portfolio. Those are the ones that don't have cash. So, I mean, if they start to shrink and not pay up, then stores cash flow completely depletes, and they're running on um, the cash that they already have. And I really don't know how much it takes operationally to keep everything afloat, but that's not a bad scenario, or I'm sorry, that's a terrible scenario to have for this type of company.
Yeah, yeah, that's a great point. So now going forward beyond REITs, things that I'm at least considering investing in, and I think Fastwell, you're on the same board of some of these, right? So Microsoft obviously being my number one pick,
Mhm.
Netflix and Facebook being the next ones. What are your thoughts on these three at least?
Oh, easily. I will recommend for my friends to my family the number one stock I will recommend, and this is not advice, but this is just my opinion. Microsoft is the number one company I'm looking to get into once this correction is over. I'm eyeing this stock every single day. It's a leader in the tech sector. It's still, even during this time where companies are not spending on technology with their CapEx dollars, they are still able to generate growth in other segments of their business, whether it's having a total gaming ecosystem. They have the gaming marketplace, they have production studios to make the games, they have streaming platforms to stream the games and connect gamer with gamer. And they also have another product, which is the Game Pass, which is like the Netflix of gaming, where you pay $15 a month and you can stream multiple games on their catalog. So that's just their gaming side. And then also on the
Yeah,
cloud side, they have Microsoft Teams, which is kind of like Slack. You can communicate um, like between divisions in a corporation, and so they have a lot of growth segments that I don't think are being talked about enough, that are actually benefiting from this type of environment. Even though the stock's gotten killed, I think it's down, 25%, 20%. This is still my number one pick for when everything, starts to clear up, because their core business in cloud enterprise was growing so fast, and now I think they're going to be able to get a lot more people to stay into their gaming category once everything's over. So, I really love Microsoft.
yeah. And thoughts on Facebook?
I like Facebook. Long term, exceptional company. They have some of the best cash generation and margins of any tech company you'll read about. But they go through a lot of headlines. That's why the stock is always wonky. Long
Yeah.
term, yeah, I love it. But depending on how this crisis plays out, it's you're seeing companies not advertise because they're not open. So they're going to lose a
Yeah.
lot of core revenue for this quarter and maybe even next quarter as businesses still close shop. So I'm waiting to see on that, but I like Facebook for the long term.
Yeah, yeah, that's a great point. Same thing with me. I think Facebook is a great long-term buy. I think they have a pretty decent sized war chest in terms of the products that they have. I think what they have, like a good amount of money saved. I looked into their balance sheets recently, and they have a good amount of money saved up. Obviously they're no Apple, but they have some money saved up. And on top of that, to actively sort of trade this, my thought process, kind of like yours, is I think their ad side is going to get hit hard in the next quarter or two at least. And I think for the short term, I'm actually looking to short Facebook down to this level around the 120s and the 130s. Because I really think that the impact on their ad revenue side is really underestimated in terms of how big of a hit they're going to take. So that's kind of my thoughts on the short term versus the long term on Facebook.
Yeah, I think for the short term, just based on what I can see, you're in the odds that the stock is probably going to go down more so than up, despite its rally over the past 2 weeks from the low. Uh, I don't know about how significant the long term effects will be on their ad business. So that's why I'm curious to see where the market prices it in, because in my opinion, it's still a short term thing. I think once businesses open back up, one of the main sources they'll advertise is they're going to go directly to Facebook again. So I don't think the core value of the product is lost. So I'm still trying to figure out where exactly it will be properly priced in. But I think
Great
you're
point.
right for a trade that it could come down.
Yeah, yeah. And then, finally, I mean, obviously, folks, you guys can look into these other stocks as well, whether it's 5G stocks. I'm actually a big fan of PepsiCo. I don't know if you are, Faisal. What are your thoughts on PepsiCo?
Oh, I like them. I think
Yeah,
they have a lot of debt though. They are pretty heavy on the debt, but their core products, with this entire crisis, debt becomes very important when assessing which stock to invest in, which ones to not. The good thing about Pepsi is, even though they do have a lot of debt, they still have cash flow coming in. As people end up staying home, they snack more, they buy more sodas.
yeah,
You may see a small hit because businesses are obviously not re-upping on their stuff, but I think they have a pretty big portfolio of consumer oriented products to where I think they'll be just fine, and they have a good dividend, and they are kind of a stable stock in my opinion in this type of environment.
yeah. That's a great point. And then finally, I mean, obviously, for those of you who are watching this, we've talked about things, at least Faisal and I are staying away from, things we're considering shorting, REITs being some of them, and movie theaters, things that we're looking to invest in, whether it's short-term shorts against Facebook, but long-term holds for Facebook. And then I explained to you the importance of the US dollar versus other governments and countries effectively wanting more US dollar. And then finally, last but not least, my go-to asset, Bitcoin. We obviously have to talk about Bitcoin and gold in times like this, because I personally see Bitcoin and gold as Chamath Palihapitiya. He's a famous investor. He likes to call it as schmuck insurance, right? Just in case the governments themselves start failing you, things really hit the fan. I would probably say, I mean, I'm not saying that Bitcoin is going to be the asset that's going to come thriving out of this whole situation. But I'm saying, if you're taking a look at it as a long-term horizon of, if this is like a decade-long thing, a 5-year long thing where economies across the board are reshaping themselves, governments and people are really starting to figure out, like, holy crap, like, what have we done to the economies? I would probably say people are going to start looking into things like gold, especially, and things like Bitcoin from just a speculative lens, right? And I say speculative with a very heavy emphasis, because obviously, in my opinion, I don't think anyone is touching Bitcoin right now thinking that this is the one thing that's going to save us, okay? But I do think that Bitcoin has the ability and the best risk to reward upside potential than any other asset out there. So going forward for Bitcoin, the one thing I'm looking at is I'm actually of the opinion that I think Bitcoin is going to go towards at least $2,000, maybe even $1,000. Okay, that's just my thoughts. And once it gets to that price, I think the whole speculators, the people who are effectively longing or shorting these assets, kind of like myself, most of these people will actually be weeded out of the market, because they'll have no reason to hold an asset that's already down, almost like 80% down or 90% down from its all-time high. Okay, so you've effectively weeded out the speculators, and what you'll really have, as we call them in the crypto space, is hodlers, right? The people who really want to hold this asset, thinking that this might be the one thing that is, quote unquote, the digital gold, the new sort of gold standard, if you will. And if that's the case, again, the risk to reward for that, the risk to, downside risk to the upside potential, significantly higher for Bitcoin than it is for any other thing, okay? And so the one thing I want you guys to take away from this is, at the very least, do your own research on Bitcoin, consider the US dollars and also gold as, potentially the schmuck insurance, as, we call it. That would be the few takeaways. And obviously these assets that you may want to stay away from, or doing more research in terms of potentially buying for the long term. And then last but not least, the one thing that we do in our community is fairly, like, we actively trade every single market. And like I said, I'm actively trading the Forex markets because they've just been so great in terms of their volatility. And then, equities in the other side, right? In the other direction, where I'm basically looking at what can I get my hands on that I personally think that's overvalued in terms of the market, and what am I looking at for the next quarter or two or three. And so my positions, they're obviously right here. I'm shorting QQQ. I got puts on the SPY for April 24, July, and September. Okay, so that's kind of what I'm doing now. Finally, what I'm going to do is open up the floor for some questions from our members who are watching. So let's see who's got some questions. All right. One of our members VP asked, why PepsiCo and not Coke? Faisal, any thoughts on that?
I haven't checked out Coke's exact portfolio, but I just know PepsiCo, from my understanding, was pretty broad in terms of snacks. Coke has more of a broad portfolio in terms of drinks, but it also has some snack items in its portfolio. So I think Coke is a good investment too. They're both going to be fine. If you like PepsiCo, you like Coke. I just think Pepsi has more of a growth center. Like, if I'm not mistaken, Pepsi is growing, I think, 7% on earnings next year versus Coke's. Let me go ahead and double check that. I think Coke is only growing maybe 3 or 4%. So Pepsi is naturally growing at a faster rate as far as from an earnings perspective than Coke is. So that's mainly why I would choose that over the other one. That's
a great point. And possibly Coke is probably a bigger market cap, so the earnings might be a little bit more slower than, say, PepsiCo.
Mm-hmm. Yeah, I think so. Coke is expected to grow next year. Oh, yeah, next year at 9% actually. Let me see. And then you're going to have, okay. So the difference, I actually got it mixed up. So this year, Coke is actually expected to decline in earnings versus Pepsi is supposed to gain 3.6%. Then Pepsi in 2021 is going to gain just a little bit upwards of 7.5% in earnings. So their rate of growth is better, but in 2021, Coke kind of makes up for it by growing, almost 9%. So it's kind of your own take. I think they're both pretty good stocks. They both have solid dividends and should be more stable equities during this time. But that's a good question.
Yeah, I think staple stocks like, Coke and Pepsi, in my opinion, are probably the more, defensive stocks that you can hold into pretty much any part of the economical process, right? Even if we're in a recession or depression, I mean, how much further is, Coke and Pepsi going to go down? I mean, yeah, they might come down a little bit, but they're not going to start falling apart like potentially, tech stocks,
It totally agree. Yeah.
Let's see. So we got some other questions. So what indicators do you use to trade? Well, I can answer that real quick. For the most part, I mean, I'm usually just raw price action trader. So I'm using moving averages here and there. I have a couple indicators that I could show you guys. So for example, I use this VPVR, which is a volume profiling visible range, which turns on these bars on the right side, you'll see. And effectively, this shows you exactly where a whole lot of volume was transacted in a particular range of price action. And again, this is not your buy or sell indicator. It's effectively to show you exactly where, more volume had taken place inside a particular range, okay? Other than that, I mean, I use the Ichimoku Cloud, which is a forward projection indicator. It helps you understand, same thing, support and resistance levels. It has these different, they call it the Tenkan-sen line, the Kijun line. It's different lines that show you, the different moving averages. Once they have a bullish cross or a bearish cross, you can consider, shorting or longing. And then TD sequential, that's another one where you'll see numbers pop up on each one of these. These are about regarding the exhaustion of buying or sell pressure as price moves up or down. 9s and 13s are effectively your tops or bottoms. So you can see 9 at the bottom that was created, 13 cemented right there. Price went up 2 more candles and then started selling off. But for the most part, I mean, I would probably say I'm mostly kind of just looking at a chart like this. And I'm trying to figure out, horizontal support and resistance levels. Sometimes I'm even looking at, diagonal support and resistance levels. So for example, in this particular instance, I'm looking at this channel right here where price has been traversing in. So when I look at this, I see that, okay, well, price has effectively been at the bottom half of this bigger channel. So that means it's a little bit more bearish in this particular area versus more bullish when it was up here. Okay, so that's kind of my take. I'll let Faisal answer his question though. Well, what about you?
Well, I mean, I kind of do the same stuff that you do as far as trying to figure out where the ranges are. I use a lot of moving averages too. And sometimes I use the Ichimoku to determine minor levels of support and resistance. But for the most part, I think in this market, it's like moving averages don't really have that much weight because everything kind of just breaks through at one time. So ranges and weekly ranges are pretty key right now. So those are kind of the technical indicators that I'm using, whether it's, that the market, the low that the market had when we were at the trade war escalation, that low is significant and it's significant technically. So you don't want to see the market break that low. I'm going to use that as one of my ranges to gauge the low of that range and then ultimately the high. But that's basically what I'm doing for the most part in today's market, is just trying to create simple ranges, both weekly, daily, and sometimes in the intraday.
Yeah, and that's a great answer. What you said about moving averages, because I think when a market is really just aggressively shifting momentum from one side to the other, like it was moving up and then drastically moved down. Moving averages don't really do shit, right? Because you're going to see all moving averages penetrated to the downside. The only thing that's going to help you is horizontals like this. So like mapping out key SR levels. So for example, if you look right here, you could see a good amount of, bottoms being formed before the big push up. And you could see that same thing. We actually came to that same area, we pushed up, and then we smashed through, So having sort of draw ranges, key support and resistance levels, as well as, Fibonacci levels, I think those will help you guys out.
Mm-hmm. Yeah, those are fun.
Well, let me see what the other questions are. Let's see. Any thoughts on Alibaba?
Oh, I like Alibaba. It's one of the very few Chinese stocks that I think you can, accurately dissect, and it looks good. If you guys have followed me on the Discord, I've liked JD.com. It has a better cash to debt ratio. I think during this entire crisis, that's just the factor that I've really weighted heavily, is how much debt do they have versus how much cash generation. And so I like JD better in that aspect, but Alibaba's, a great stock long term. If you like JD, you have to like Alibaba. There's nothing really not to like about it, especially since the worst of the virus is pretty much over in China, hopefully.
Yeah, that's a great point. Let me see if there's any other questions. Any thoughts on Internet 3.0 AI projects? It looks like the person said this crisis has exposed internet providers and the need for AI management of digital delivery content. Yeah, what's your thoughts on AI? And even we can even get into 5G too, because obviously if we're talking about AI, we need to have capability and bandwidth as per our providers.
Well, I'm gonna be honest. I don't know about the internet providers, to expose the internet providers. So maybe I need to do some research on that. Is that associated with what I'm seeing regarding Netflix lowering their video quality?
Yes.
Okay, so that's it. Got it.
Yeah.
Okay,
Well,
I'm sorry. Go ahead.
Yeah. So I mean, I think the point is, demand aggressively stepped up because, again, like many sectors across the board, no one really saw this kind of event, essentially putting so much pressure on their respective platforms and their networks. So, you can sort of expand the ability for content providers as well as internet providers to have more of, like state-of-the-art upgrades in terms of the connections that they provide, the bandwidth that they have. And then I think that effectively ties into 5G, because if we're talking 5G, then you're effectively talking about more, bandwidth usage, from a per customer standpoint, as well as, speed.
Mm-hmm. Okay.
So, but yeah, I mean, I haven't really followed that many 5G stocks, and AI I know even less about, but I have read some newsletters from, other investors whether it's like private equity companies and, other smarter investors who talk about those. Let's see, another question. Many established players that are in better positions can be considered for AI. Micron, NVIDIA, and AMD.
Yeah, that's true. They're all going to be powering a lot of the technology that's going to be using 5G. So semis is a great way to play 5G, in my opinion. It's one of the safer ways to play it rather than trying to figure out, Nokia. Like for instance, Nokia has always been in the 5G headlines, and yet I remember I was excited about the stock at $7, and now it's like $3. So they got a lot of
Yeah.
problems on their own term. Charter's a really big one too. They've been hit from this correction, but they're a very good company too. I think they're probably going to be the best ones to benefit from it. But the safest plays, I think, are still in the semi space.
Good point. Good point. Are there particular semi ETFs that you look at? Because if people are looking at semis as an investment potential, instead of looking at individuals like Micron and Nvidia, do you have some that that are exposed to those stocks?
Yeah, I've watched two. So there's SMH, which I think has a lot of the semi equipment. So the equipment that's used to make the semi chips is like its whole different industry too, and that's kind of weighted a lot with that. And then there's also SOX, SOXX, which I think is more of the just regular chip type of ETF. And they both kind of trade the same because both subsectors move the same from day to day. But those are two of the ETFs that I watch.
Good point. Good point. All right. I don't know if we have any more questions, but last but not least,
there's one. I think, would you short the housing market due to all the layoffs and anticipated foreclosures? I don't know if I would short them because if you look at stocks like, just go ahead and check out ITB. It's a housing ETF that I follow. Yeah. I mean, you see how fast it's dropped. It's dropped more than 50% at this time. So, I mean,
yeah.
At this point, I'm thinking to myself, damn, is the worst already priced in? Are we really already pricing in the foreclosures? Or is it because there was a lot of supply before the correction and now that people are staying home and money's tight, people are not looking to buy homes? So that's just like a sudden shock to their earnings. I'm still trying to figure that out. So usually when I'm still trying to figure how things are priced in, I don't like to make any moves like shorting or going in a long-term position. But that's just my stance on it. I think there's just too much risk to even make a trade.
Yeah, that's a good point. I think I'm personally of the opinion that I think housing market's probably going to start rolling over even more so in the coming few months. Because I think one thing that's heavily dependent on that is how is the government going to react with people potentially defaulting on their mortgages, not being able to pay their rent, whether it's commercial or private and personal properties. I think obviously the government reaction to all this has so far been decent, but people still have not gotten money in their pockets to actually pay their rent, right? So the question is, are we going to start seeing rollovers into REITs as well as, the housing sector, right? And obviously so far, the housing market itself is clearly reacting to the market pretty adversely. So I guess, I'm kind of in the same boat as you. I do think it's going to go down, but it's hard to say, if we're going to start seeing even the housing market being propped up by, government stimulus, or does it just kind of continue to slide down even further?
I will say I did take a look at a good amount of these names this morning. A lot of them, you'd be surprised, they are not that leveraged. Like you talk about a company like Lennar. Lennar has zero debt, and it's one of the biggest home builders. And this is, coming off of the housing crisis where everyone thinks, oh man, they got bailed out. They probably have so much debt. Toll Brothers is still manageable. All of them have manageable debt for the most part. DHI, PHM. So that's one area that I think is going to be beneficial and could help in the recovery cycle of this sector, because I don't think they're going to need to be bailed out, but that remains to be seen as far as how long this crisis lasts. But that's just something to keep an eye on. It's not like the oil sector where they're already heavily leveraged and they're already in a bad position. These guys are actually decent from my perspective.
That's a good point. And by the way, folks, We actually, Faisal and I do these videos every single Sunday. We do a recap for our community, and people, you can watch on YouTube if you want to. But going forward, we're actually going to start delivering more and more content that is more private to our paid members. And, like I said, we opened up the Forex channels, the equities channels, commodities, as well as options. So you're going to have a ton of different assets to trade along with crypto, obviously. So if you are interested in trading with us or understanding how to invest, you can come join. And finally, I'm going to let Faisal take over talking about his newsletter that he's starting up, which I think also adds significant value to our community. So I really appreciate him doing that. I'll let you take it away on this newsletter, how you came up with this, and what are people supposed to, when they read this, what are people supposed to, I guess, understand and take away from this?
Yeah, so I want to say since 2013, maybe, actually, I'm sorry, 2013 is when I started. 2015 is when I really started to notice that stocks moved in such a way that was so methodical that money would move out of one sector and go into another almost immediately, that secular investing and that theory instantly attached to me. And there's some research on it. There's a fair amount, but I think in this environment with my trading perspective and how I traded the market, it really ended up boosting my success and getting me into a lot of good trades before their big moves even happened. So I kind of just wanted to make a newsletter detailing some things about secular investing and going through how I looked at the sectors this week. I kind of break them down into different sectors as far as categorizing them into leaders or being a part of the weak sectors or the loser of the week. I kind of just did a whole deep dive into sectors and then a couple of the stocks that are in those different categories. So if you want to just go down, this is like just an explanation. If you want to just keep going down, yeah, I got a little summary in there. It's kind of a long report a little bit, but those are some of the, go up a little bit. Yeah, so this is just some of the ranks. And my theory is that if you start trading within the tier 1, tier 2s, that significantly increases your odds of success because you're getting into the right sectors that are having that momentum. It's all about secular momentum in this market because money is able to move in and out so fast, and there's constantly different webs being pulled, whether it's interest rates going lower, so that means financials are not going to be doing as well, or oil going lower, and that means oil assets are not going to be doing well, or interest rates moving lower and utilities are going to go up. It's all a different web, and I think the way I kind of organized it, I hope I could kind of decipher that web for people who are not familiar with it. So if you kind of go down it, it's got a bunch of the ranks for the week. I update them. It's going to come out every week. I go through a lot of dissection within each sector, some of the things that happen, and then I have my stock of the week. And I kind of break through that, why I liked it. And, it's 21 pages of goodness, in my opinion. It's a pretty decent report, and I wanted to kind of give it to people for a really nice price, $7, because that's just my favorite number. But yeah, that's pretty much it. I was just like, might as well do it for $7. I have a passion for this stuff, so this is already on my mind, and I'm already doing this stuff for myself. I just thought might as well share it with the community and hopefully educate a lot of people who don't have, from having zero experience to having a lot of experience, that they can find ideas and hopefully gain from information out of this. So I really hope you guys like it. You guys should really let me know what you guys don't like, anything like that. I'm all open to criticism, and the design could change. Like, you guys could comment on anything. I really value y'all's perspective. So yeah, that's it.
Yeah.
I hope you guys really enjoy it.
Yeah, this is a fantastic newsletter. And again, folks, if you go to the Cryptosomniac website, you hit the products page. In the Advantage membership, you'll pretty much get everything that we've talked about today. The newsletter will be put on, separately real soon. But other than that, I really appreciate everyone coming in to join our session. Yeah.
I do want to talk. I just saw someone does have a pretty interesting question that I don't know if we talked about. It's about investing in the medicine and vaccinations part of the entire market. So I just want to give a quick shout out to that. So there are people who are following the vaccination process and how everything's being updated. If you saw that that last week we had Abbott Labs come out with new testing equipment, and then Johnson & Johnson moved forward in their vaccine trial phase. A lot of people are thinking, okay, things are moving along, and this should end up maybe creating some optimism in the market or even for the stocks. But it's still my opinion that these stocks, even stocks like Johnson & Johnson, are still not showing me enough momentum to qualify or to tell me that, okay, even though they are making progressive updates, the market is not going to value that at this moment. So I just wanted to touch upon that. That's my opinion. I would wait for these stocks. Like, I think Johnson & Johnson is a fantastic company, excluding all the lawsuits, terrible lawsuit stuff that they have. They're really well managed. They're a very well managed company. They have great product lines. And so I'm looking to get into this one long term, but I'm thinking it's going to come down closer to 120, maybe 115 before I do.
Yeah, that's a great point.
Mm-hmm.
Let's see. I think that's pretty much it.
Yeah.
I don't want to get into too many questions because I feel like this is gonna take forever. But one last thing, one of our other admins, he mentioned that, imagine taking forbearance for 6 months, and then the banks say you owe them the total of 6 months, and then the next 6 months to make whole. So I think he's effectively talking about the slide that may be happening in the housing markets, because I think he's talking about, let me see here. He explained it earlier. So they could give you the option, but forbearance means that, pause in payments and then the whole amount due at the end of the period, right? So if they cannot do that, then they go to a loss mitigation with the lender, and then they give you options to restructure your loan, which could also affect your credit. It's like a whole cycle of shit, basically, that, whether it's the lenders, whether it's property owners, whether it's people who are renting the property. This is what I mean by the housing market effectively being in a tough line, right? I don't think anything in this market, like we talked about at the beginning of this video, this is not a sector-based drawdown in the American economy. This is a everything drawdown across the board. Nothing is really safe,
Mm-hmm.
So I would not be surprised if, housing sector sees a little bit of trouble. I'm not going to say it's going to start falling apart, but I think it's fairly obvious to say that, REITs across the board, even home construction companies, lenders, and even banks, you could see how it's a domino effect that everything is related to everything effectively.
Exactly. Yeah, it's like we said before, no crisis has ever been this widespread. Even though we've had diseases in the past, we've never had to hold up so many different industries, and the housing is just one of them that continues to have a lot of stress. I will say, I think we'll be talking about it in the later half of the crisis versus now, but that's just my take on it. Housing is really, we probably haven't seen the worst of it yet at all.
Yeah, great point. Well, on that note, well, I'm going to leave it to you guys, folks. It's Sunday afternoon. I hope you do go spend some time with your family and friends. Take care of yourself and your health, and do come join our community. Again, it's just $97 a month, and you get to talk to me and Faisal pretty much all the time, trade multiple assets across the board, or even just come here to learn how to trade or learn how to understand what's happening in the markets by reading our analysis. I put up these daily videos pretty much every single day regarding crypto and some Forex breakdowns. In this, Bitcoin analysis section right here, you can see these videos. I do them twice a day, so evening and morning. And then I have multiple updates that I put out through the day. And then Faisal himself does a equities update morning and, so opening and closing of the market right here. So open right there and then closing right there. So you kind of get an understanding of what's happening in multiple markets. And he does oil updates too. So anyway, I hope you guys enjoy this content. Share it with your friends, your family. I hope they learn something from this. I hope you learn something from it. And with that being said, I'll catch y'all next week. All right. Take care. Cheers.
Take care.